Warren Buffett, probably one of the greatest investors of our time, said one of the most important lessons that he learned from Ben Graham was price is what you pay, value is what you get. Basically, there needs to be value added for any additional expense. Cheaper cost is not necessarily going to maximize returns for clients. This is particularly important when we're talking about risk-adjusted returns and we're talking about short and medium times. So, for example, the composition of indexes. Indexes are generally a very cheap way of investing. And indeed, there's a whole school of thought that says you can't beat the market, just put it all in passive investments. Besides the obvious flaw with that argument that, well, if everyone invested passively, markets would cease to exist. But anyway, for the sake of it, let's run with that. Indexes have fundamental weaknesses, which, sure, if you invest for 40 years, there mightn't be any difference. But the reality is with clients and their relationships, their financial journey, that when they're looking at investments, they don't just look at it in 40 years. They're looking at it in, over 6 months, they're looking at it over 12 months, looking over a few years. And in line with the risk-adjusted return basis that we take for managing the strategies, we want to make sure that that rides as smooth as possible, which basically means we want to try and avoid big drawdowns. So when we're looking at the composition of indexes, it's important to, whilst we appreciate their strengths, which is obviously their low cost, we also have to acknowledge their weaknesses. And the composition of indexes does have weaknesses, and particularly in periods of market change, those differences can be exacerbated. So, for example, good examples are recently fixed interest. So we've been talking the last few years about increasing interest rates and the impact that would have on investments that have long duration bonds, which is predominantly all fixed interest passive investments, and they absolutely got smacked. So, for example, in the United States, over the last calendar year, their long dated treasuries fell 30%. That's not a good result for your defensive part of your portfolio. Whereas what you'd want to be doing is actively managing that and protecting that risk so you didn't have that drawdown. Equities indexes, similar sort of thing. If you're in a market weight index, cap index, obviously the more expensive a share is, the more you own. We've just seen the unraveling of a lot of the tech sector, which has resulted in a lot of the market weight caps getting hit quite hard. So once again, just appreciating what the strengths, but also the weakness are, and that does definitely have an impact over the shorter to medium term on these investments. Unless, of course, you're comfortable that your client's going to put all their money in and then come back in 40 years. The other reality with cost is that certain assets are more expensive. So in our quest for looking for non-correlated assets, we have to go and look for different assets. So if we're going to go and purchase equities are very accessible, very cheap. If we're going to go and purchase a building, well, there's more expense associated with that. We're going to go purchase a toll road. If we're going to purchase a port or an airport, they're assets. They're going to have a lot more cost associated with what's required to actively buy these assets. So it's just the nature of the more diversified your portfolio is, your cost has to creep up. Also, certain strategies are more expensive. So, for example, if we're just going to buy a heap of shares and throw them in the bottom drawer, it doesn't cost very much. If we want to undertake, say, long-short strategies where we're looking to protect the risk, where we might buy some shares, we go and sell others to basically remove the market risk, there's obviously a lot more management involved in that, and there's a lot more cost. So it gets back to, we need to assess what that cost is, and is there any additional benefit? And depending on the point in the cycle, the investment cycle will determine which assets and strategies we want to be exposed to. So, in theory, times like this where we're actually looks like secular changes happening in the markets, my view is we actually want to be away from those cheaper index type plays and we actually need to get a lot more active, and we need to get a lot more exposure to other sorts of assets and strategies. So inherently the cost will go up, but in saying that, what does the outcome? And we've seen that in the last 18 months that we've avoided a lot of the drawdown because we've had exposure to those strategies. So whilst the cost was higher, the value is there, and we can see that. And that's the role of the investment committee. It's to balance all of those considerations on an ongoing basis, and make sure that we're building the strategy to get that risk adjusted outcome in a reasonable cost environment.